All right, welcome back to Two Stupid Gas Trade Stocks. I'm Vinny.
I'm Dylan.
Today we're going to talk about Queen Cathie's number 2 position, Teladoc Health. For those of you who don't know, both Dylan and I work in medicine, so we kind of want to add a little bit of takes. We're both interested in investing. So I want to walk through Teladoc Health and talk a little bit about what I think the valuation is and what sort of stuff they need to do in order to achieve that valuation.
And if this is another Cathie Wood's crazy stock, if you like watching two stupid guys kind of figure everything out with stocks and investments, go ahead and give us a like and subscribe. Thank you.
All right.
Two stupid guys trade stocks.
All right. So Queen Cathie, the anointed saint of hyper growth stocks and disruptive industry innovation stocks. Teladoc Health has kind of had like a really rough 6 months or so, along with her main flagship fund has languished a little bit. This is the number 3 position in her main fund, and I want to say overall, if you look at all of the ARK Innovation ETFs, this Teladoc Health is number 2 because it's like the number 1 in ARK Genomics as well. But yeah. So, as typical for these kind of like really disruptive innovation stocks, tremendous top line growth, which has been absolutely awesome. I mean, it's very commendable to see strong double-digit growth, like, consistently throughout the last 5 years here. Basically from I would say almost nothing. It's kind of funny when we look at this from a large corporation standpoint, almost nothing, to over $1 billion last year. Had that nice like COVID, I think, pull forward a little bit where they generated over $1 billion in revenue last year, which is very impressive.
It'll be interesting to see what they do for 2021.
Yeah, I know, right? So stock has kind of really languished here. Well, peaked out up in the 300s or so back in the beginning of 2021, and now it's kind of sold off. Now, like less than half of where it was at that point in time. So the real question is now with this massive sell-off, where does that bring the kind of in the realm of something I'd be interested in investing in? But we'll see. We're going to do a little bit deeper dive into some of the numbers here. So they got quite a pandemic boost last year because of this payment parity with in-person visits because of the Center for Medicare and Medicaid basically said that they relaxed the rules on terms of billing for telehealth, and because of that, telehealth saw like a significant boom because they were able to finally get compensated equal to in-person visits.
Yeah. And just so people understand what the medical parity basically was, essentially because we were trying to limit spread and limit people traveling for doctor's visits and being in doctor's room, they basically made the rules, regulations, and guidelines for accepting telehealth versus in-person medicine. They made the billing like way easier. So that was a very temporary measure.
Exactly. Many private insurance companies kind of followed suit. But unfortunately, Medicare ended the parity in July of 2021. Unfortunately for Teladoc, the private insurance companies actually had ended it even sooner than because they weren't even mandated to do it. So they kind of backed off from that a little bit sooner, all of them at their own timetables. But so it's over now. This demonstrates this is from the state of Michigan, looking at in-person versus telehealth visits, during like the pandemic era here. So immediately as we saw lockdowns come into place, you saw in-person visits kind of take this real steep dive off here, and you saw this rapid kind of rise in telehealth visits. Still, the total number of visits was still down significantly throughout, like the next 6 months or so. It kind of came back towards normal. Telehealth came down as a percentage of it, and been hovering right around that 20% or so. In terms of the number of visits, which is still good, significant boost from where they were pre-pandemic.
Yeah, I mean that's a giant boost. It's pretty wild.
So this is kind of part of the story here with the reason why you've seen this, precipitous drop in Teladoc stock over the last year, is that the company had the tremendous growth in 2020, and now it's having a hard time keeping that pace, that momentum going forward. So when you're growing at 100% annually, you need to be growing quarter over quarter, 20%. And you've seen the quarter over quarter growth drop from 20% to 10% to now the estimate for this most recent quarter that's going to be announcing their results here soon was only about 3% the anticipated quarter over quarter growth in terms of revenue.
Now I haven't looked at this company like you have. Are they an Intel where they make a giant amount of money and don't have to spend as much? Because 3% is fine for that.
No.
Are they an AMD?
Nope.
Oh, it's not even AMD because AMD putting up 3% growth would also tank.
No, they're not. They're not AMD.
Oof.
So this is one of the other stories from 2020 is that they actually closed on the acquisition of this company Livongo. Livongo is a little bit different from Teladoc Health. Teladoc Health is really focused on more like sick visits, like respiratory care visits, psychiatric health. It's a subscription-based model. Livongo is more of a chronic disease management company, particularly diabetes is where they had really good data. And this is very impressive because companies absolutely love to see this sort of data. Is that Livongo actually save members, and reduce the cost for members of about 22% per, for diabetes management, which would save over $1,000 a year, which is very, very impressive. For those who are unaware, oftentimes, you're reimbursed for kind of good care is how medicine's paid for these days. So every hospitalization that you prevent, basically you get a percentage of that back as like a bonus from Medicare.
Right.
Yeah.
Those are like ongoing stats that you use for the previous year and over and over and over. It's pretty wild.
Exactly.
That's 20%. That's pretty good.
No, yeah, I thought that was fantastic, and and it's not just about the cost savings too, right? If you're saving that 20%, it's because you're actually giving your patients better health. People are managing diabetes better, that they're able to like live their lives to a better extent. Maybe even potentially have a little bit more longevity. With their diabetes being well controlled. So great things. The aligned compensation with good things for the patient. And this is another thing that was interesting with Teladoc Health. So JD Power basically for 3 years now is awarded like the best like telehealth provider, and Teladoc has won it 2 years out of the 3 years, so which is very impressive. So one of the things that they're fighting though is that it's a relatively low barrier to entry business, right? It's basically like, we're on StreamYard and we're both medical professionals. Like, we put a third person on here, we could be doing telehealth right here. Okay. Like it's not, it's not that hard for people to get into it. Livongo has a little bit more of a moat than Teladoc itself, but when you look at Morningstar and their analyst report, they have Teladoc Health as a no moat business, basically.
I 100% agree with that.
Yeah. There's a lot of startups like Amazon has actually even started on their own internal thing to actually have a Teladoc-esque kind of capability for their employees.
I think that anytime Amazon's entering the space, that's terrifying.
Agreed. There's still some though. Like I still regret not loading up on CVS the day Amazon announced that they were going to move into the pharmacy industry. Anyways, so this is the gross margin for Teladoc Health. We think of a 70% gross margin.
I think because you told me what gross margin was right before this, I think it's pretty good.
Yeah, it's a fantastic. Google has like a 70% gross margin.
I'm a technical analyst kind of guy.
I gotcha. So fantastic, right? Like that means that for every dollar in revenue that they're bringing in, it only costs them 30 cents.
Yeah, that's right.
Actual components, right? Because what do they really need? They need to have the provider to do the visit. They need to have a software and like kind of a server capabilities. Like it's not a lot per visit that it costs them.
Yeah. This is going to be a question for later, but I just thought of this. For that 30 cents that they pay out, would the provider payout be in that 30 cents?
Yes.
Okay, that's going to be important for later.
The provider would be in that. This is what their guidance basically for this year is what I was kind of focused on. So looking at about $2 billion in revenue. Adjusted EBITDA, they love to throw this number out there. I hate it because they're ignoring a whole bunch of stock-based comp. Basically, you can throw that in the trash as far as I'm concerned. But yeah, it irritates me a little bit. Paid members is kind of slowly growing, which is it's good that it's growing, but it's not growing at that absolutely astronomical clip that they're talking about the revenue growth, which is unfortunate. And then visits, they are growing pretty significantly. Like 20% year growth is pretty good, especially coming out of that pandemic era where they had the pandemic pull forward.
For sure.
I'm happy to see that. Now I did some projections. All right. So I gave them a 30% compound annual growth rate on the revenue. All right. Let's say 2019, they grew just over 30%. So pre-pandemic era, they were just growing about 30%. I think it's very reasonable for them to continue a 30% growth rate forward, and I project my numbers for 2026. I continue the gross margin of 68%. Now, this one, I'm a little mixed on this. So, net margin of 30%. A net margin of 30% is very much achievable with a gross margin of 68%. That is what Google gets. Google has about a 70% gross margin and gets about 30%. I'm sorry, gross margin and gets about 30% net margin. But to date, they haven't demonstrated their ability to do that. I don't think there's a reason they can't. They just haven't done it yet. All right. And I gave them a P 30. People can disagree with this, whatever, but P 30 I think is reasonable for a company growing 30% per year. Some people, I'm not going to go meet Kevin over here and give you a 70 PE on a company growing 30% a year. This I didn't love.
Shots fired.
What? Yeah, I know, right?
No, there you go.
Share dilution. They dilute like no tomorrow. They had to dilute a ton to fund that Livongo merger, but they were diluting before then and will continue to dilute in the future, for foreseeable future. Basically, they actually like doubled the number of shares outstanding last year.
So they doubled the number of shares outstanding last year when they had the ability to just rake it. That's weird. Why would you do that?
I know, right? Well, they had to fund that $18.5 billion acquisition. So they paid $18.5 billion between stock and cash, and right now, if you look at them, their market cap is like $20 billion. So,
man,
yeah, it's a little weird.
Oof.
So 2026 estimates, I projected about $7 billion in revenue. It's like a 3x basically from where they are this year. Given them the net profit of that 30% margin, which, like I said, they haven't shown that they could achieve yet, but it's reasonable given their business structure. That would give them a 2.23 billion net profit. So times the 30 PE would give them a $67 billion market cap. Now, I predicted number of shares outstanding based on that 10% per year dilution, which I said is aggressive compared to some companies, but not unreasonable given their history. So I predicted a 2026 share price here of about $266. All right.
That's like double where they're at right now.
Yeah. So I used a 15% compound annual growth rate here. So I want to get at least a 15% return, basically. And then I gave myself a 30% discount, assuming that things don't actually happen. And that would give you a margin of safety buying price if you think these, Teladoc is able to achieve these things within a reasonable level of certainty. You can feel relatively comfortable buying at about a $92 a share, which is still a fair discount from where it is now. But it's actually not as overpriced as I would have expected. Now, there's a lot of issues with this because it's a real question of whether or not management can execute on this. Because, like I said, they have not yet to date proven that they can, even achieve even a 0.1% net margin. They're paying out everything in stock-based comp, but it is possible based on their business model.
That's like your pet peeve is share dilution.
It
frequently, especially for acquisitions. You hate that.
I mean, it's not for acquisitions per se, but I definitely have an issue with share dilution because people don't see it, right? Like it's not something you think about. You just think about the share price or whatever. But think of it as if there was a pizza, right? And like I don't know if you have any places near you, and there's one near me where they'll actually ask you like how many slices do you want us to put this pizza in? Do you want to like slice it 8 ways? Do you want to slice 16? Like they're not giving you any more pizza. All they're doing is cutting that pizza into smaller pieces.
You have a pizza place that asks you how many slices you want in the thing?
Yeah, they do.
That's outrageous to me.
One place that does that, I think it's a big pizza, but they'll do it 8, they'll do 16, or they'll do like the little squares and cut it into like 32 if you're like having a party.
That's outrageous. I don't like that.
But that's all they're doing. They're just slicing the goddamn telehealth pie.
Oh, Vinny, I'm in Fubo. I know.
Oh,
don't you worry.
But this is kind of just what that compound annual growth rate looks like in terms of their share price. I still want to add a couple things here.
So yeah, this is I didn't really know much about this. This video was obviously it was Vinny's idea, so I wanted to bone up on some of the stuff that they actually do. I got to be honest, I would never invest in this company, and the biggest thing is the no moat. So basically, can you explain what a moat is?
So the moat makes me think of Warren Buffett, right? He talked about how you could give him $10 billion in cash and he wouldn't go out and try to compete with Coca-Cola because they're Coca-Cola. They have the brand, they have, the formula for the actual soda. Like the moat is what keeps competitors out.
like Boeing has, like, there's not many companies that are about to just start building planes.
Yeah.
Right. So the no moat here is a problem. And the biggest thing is I see Zoom as being a huge competitor because one, they're HIPAA compliant, which is a regulation that you have to have for Medicare billing and private insurance billing. And then during the relaxed billing guidelines of COVID, most offices, well, when I say most, all the offices that I knew just use Zoom. The reasoning is if you own an office and you have, even if you're a big network, you have a bunch of providers, your provider can make, I don't know, like, depending on if you're a mid-level or a doc, you can make between like 50 and 100 on said telehealth or teledoc, or you can just do Zoom doing the exact same amount of work and just make like 5 times that. So to me, I don't know why. Zoom just seems like a very obvious choice. I don't like telehealth is absolutely needed, like especially for those chronic like diabetes, hypertension, 100% absolutely needed.
Yeah.
I just don't like the low adaptability of medical insurance billing because if anyone's out there who knows that, it is like an enigma. It changes every couple of years, just trying to do everything it can to reimburse us with less as possible. And then on top of this, I really only see this being used for like mental health and like 2 dermatology conditions.
Yeah.
So like I get people that use, you know what Curology is?
Curology. No, I've never heard of it.
It's like an acne one. I get people that just leave that all the time because it doesn't work. Because they won't do certain meds and all this stuff. There's all these weird rules and like really common sense stuff that you should have.
Yeah.
I don't think that this is a good deal. I don't.
No,
like I said, we could get a user on right now and then just bill a telehealth visit. Like I don't.
Yeah. I mean, I think it's interesting. I you know their kind of business model. Basically, I love when you're providing a software, right? Because like the profit margins with providing a software are, you know, nice and wide. You know, there's plenty of room to be made there. But I think it is interesting too, also in that they market to employers basically. So they're trying to become a like kind of a add-on benefit, you know, be part of your benefits package, right? So, you know, your employer gives you dental health coverage. They give you like, you know, a little bit of what do you call it? Disability insurance, something like that. Basically, they would also give you access to this, so that way you can just be like, you know, I got kind of a sore throat. Let me call in and get like a sick visit from Teladoc. That's where their subscriptions are coming from.
Yeah, no, for sure.
Yeah,
I have the chart up if you want to see it.
yeah, and
that makes perfect sense.
Might be interesting for like a little swing opportunity right now. I thought maybe, but I don't know.
I'm gonna say no.
No.
This is where COVID was, so I'm gonna zoom in. Obviously, so boom, we have this giant upkeep to like 308. Here's where we're at. I'm gonna zoom in a lot. I would not take this as a swing because we're not setting. So you have your lower lows, lower highs. So high, 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 high. They're not beating each other once. Yeah. Until this sets like a lower high on the way up. That's the floors and ceilings thing. If anything, I would short this when it hits 139, to be honest.
Okay. Good to know.
I would do the opposite. I would
short at 139.
If it hits like 138-ish, I would probably go short.
Okay.
I'd buy a put.
Yeah. Hey, you know, who knows, man?
That was the opposite of what you were hoping for.
No. Like I don't know. Like I am still not the chart analyst. You know, I like the numbers. Like I said, the numbers assume a lot of things, but it's interesting. I'm not convinced, but it's interesting.
Yeah. The big support they broke through, unfortunately. The big support was at 135.
Yeah.
They lost it. They went down to 120. So
all right. Well, let us know what you guys think about Teladoc Health. We're curious.
Yep. Have a good one, guys.